Hello, today we'll talk about NAV of mutual fund, and I'll be explaining to you what NAV is, how it is calculated, and what are the factors which govern it. That means which are the factors which affect its value from behind the scenes. Agenda is I'll be explaining what is NFO, and then I'll be talking about what is NFO versus IPO. That means not only the differences between NFO and IPO, as but the similarities as well. Then I've come up with some working scenarios to make investors understand how NAV gets calculated and what are the factors which make NAVs change. And then at the end, there will be some takeaways which you can apply in calculating your returns or investing in your mutual funds, selecting schemes if you're a mutual fund investor. So NFO, as the definition says, it's an introduction of new mutual fund scheme by an asset management company, and during an NFO period, investors can buy unit at the starting price, which is defined by asset management company. Usually, it is 10, but it can be anything. It's not a fixed. It's not mandatory that they keep it 10, but for calculation, making calculations easier, it is kept at 10 rupees so that investors can quickly calculate and get a sense that how my mutual fund scheme is performing. Now, I have seen some advertisement saying that you are getting this scheme at 10 rupees, so it is cheap. Invest in it. No, don't go by that. Anything which is low price, it's not actually cheap, or you should invest without looking at the fundamentals. Definitely not mutual fund NFO, and we'll talk about it in later slides. The fund officially starts when all the money has been raised, NFO period has ended, fund manager has clear idea how much money he has to invest, and so that he can decide accordingly the allocations and the of the securities which he has should have been selected before launching the scheme or during NFO period. And investors own the units at NAV, as I said, usually 10 rupees per unit, and that's how their portfolio should behave going forward. Now, here NFO versus IPO, the points of differences. One is definition, as NFO is introduced by AMCs to launch new schemes in the market, while IPO involves companies which are raising money so that their share can get listed in stock exchanges. Now, price determination is NAV is fixed. Like I said, mostly it's 10 rupees, and it's not at all influenced by market demand supply. It's not that. Uh, scheme has raised 1000 rupees, so NAV will be 10 rupees, and some other scheme has raised, say, 500 rupees, its NAV will be 5 rupees. No, NAV is fixed. It is not influenced by market demand or supply. While in case of IPOs, yes, the issue price does get affected by supply and demand. You might have, if you're an IPO investor, you might have seen that they give a range that, say, I want to list my stock at, say, 36 to 48 rupees, and based on supply and demand, the price gets decided. Now, again, importance of pricing, NAV value is not crucial. As I said, it's not that 10 rupee is cheap, but while in case of IPO, looking at the price, you can multiply it by the number of stock after uh, IPO is done, so that you can get the whole company valuation or market capitalization. Based on that, you can figure out whether it is overvalued, undervalued, or rightly valued by the information given in the RHP, the balance sheet, cash flow statement, and P&L statement. The purpose of NFO is to aim at particular specific investments objectives and then buy the shares of the companies. While in the case of IPO, it is of a raise for capital for companies' growth or working capital or capex, or maybe some existing investor is getting out of that company, so he's selling full share or partial share of his in that company. Now, investor categories, in case of NFOs, there are no investor categories. All investors are same. While in case of IPO, there is a quota for different types of investors like retail investors, HNIs, NIIs, QIBs, FIIs, etc. Initiative, who takes the initiative? As we discussed, NFO is launched by AMCs, while IPO is launched by the companies who want to raise new money and get their shares listed in stock market. Here are the points of similarities. Both NFO and IPO, they raise funds. Uh, both introduction of new securities in the financial markets after NFO or IPO closes, and the shares or new funds, new units of schemes are listed in the financial markets. Both of them involve investor participation, and in both of them, there will be some costs associated in running the NFO or IPO, which includes marketing and communication and administration, legal and compliance costs. And after including these costs, only the IPO prices and NFO prices are calculated. Now, here is a simple formula for NAV. You can calculate NAV of any of the, even your portfolio as well. It is fund assets minus fund liabilities divided by the number of units outstanding. Fund assets is typically the portfolio companies, the stocks, prices multiplied by number of stocks in the portfolio. Liabilities, as we discussed in the last slide, they are the marketing cost, legal cost, administration cost, compliance cost, etc. And the number of units outstanding is the number of units which have been sold to investors or allotted to investors, and investors continue to hold those units. So as you can see, the value of NAV goes up in case fund assets go up, and it goes down in case fund liabilities increase. But generally, fund liabilities like cost of running funds, you can get an idea from the total expenses which are mentioned in the scheme information document or other fact sheets of a mutual fund scheme. They usually don't vary too much, so it all depends on how the portfolio is doing, what are the stocks and other assets like commodities, if or the derivatives which have been in the investment portfolio of that mutual fund are doing. Now, here I have come up with some scenarios. So let's say an NFO has come in which the three investors have invested 3,000, 3,000, and 4,000, and they get NAV allotted at rupees 10 for sake of simplicity, and hence the number of units allotted to them are 300, 300, and 400. So at the end of NFO period, they will have, say, 1 and 2 will have 3,000 rupees each invested in portfolio, and the third investor would have 4,000 rupees invested. Now, second, say on day one, fund manager has got 10,000 rupees from three investors, and he decided to buy 100 stocks each of companies A, B, C, and D, and the stock prices are 10, 20, 30, and 40. So if you multiply stock prices by the number of stocks, you get the amount invested in each of the companies, and you get a total of 10,000 rupees. So suppose nothing changes, and there are no legal or administrative costs for running this particular scheme. So total money received is 10,000. Total portfolio value is 10,000 at the end of day one. Now, suppose on day two, uh, fund manager doesn't do anything. It doesn't buy any stock, doesn't sell any stock, but the stock prices, being stock prices, they change at the end of day on day two. So the stock prices are 11, 19, 29, 34. So amount invested would be changing. So total portfolio value comes around 9,300. Total units were 1,000 rupees. So NAV would be 9,300 by 1,000, which is 9.3. So investor one and two who had 300 each, their portfolio value will be 2790, and investor three would have 400 units. His portfolio value will be 3720. NAV would be 9.3. Suppose scenario two emerges in which the fund manager has taken some action. He has bought some stocks, sold some stocks, and didn't do anything with stock D. And prices of those stocks have changed as well. So amount invested changes. Total portfolio value comes around 9360 divided by number of units, which is 9,000. So we come at NAV of 9.36. Now, investor one similarly, and investor two, they had 300 units each, so their portfolio value is 2808. Investor three, who had 400 units, he has 3744. Total value again is 9360, which is 6.4% dip from 10,000 rupees, which were originally invested in NFO. Now, suppose scenario three is there, in which company D was sold and company E was bought, as well as all the other stocks, say A, B, C, were some sold, some bought more. and the prices have also undergone change. Again, the total portfolio value gets calculated by calculating amount invested in each company, and total units are again 1,000. So NAV comes around 9.53 because total portfolio value comes around 9530. So investor one has and two has 300 value each in number of units. So their portfolio value is 2859. Investor three has 400 units. So his portfolio value is 3812. So this is how you see that either the number of stocks change of a particular company, or their prices change, or both, or some stock gets sold, some other gets added, etc. These are the factors which affect NAVs. Now assume that some investor has come and he has invested, say, 1,000 rupees, or say 953 rupees at the end of day two, and scenario after scenario three, he would be allocated say 100 units of NAV. The total money would be 99530 plus 953, so around 1000 10,433, and the total units will be 1433 only. So nothing will change, the NAV will remain the same. So what we learn from this is, if money gets added to a portfolio mutual fund scheme, NAV doesn't change. So money added or debited, the portfolio value doesn't change, but it anyway is dependent on the number of stocks, how those stocks are doing, and if any transaction is executed by the fund manager, that affects the NAV. The key takeaways from this video would be that there are many similarities as well as differences between NFOs and IPOs. NFO NAV can be anything. Usually it is 10, but 10, as we discussed earlier, it doesn't signify cheap or expensive at the same time. Uh, Again, this third point I emphasized before. It doesn't signify it is cheap or expensive, because you as NFO money is yet to be used by buying the stocks. So whether those stocks are cheap or undervalued or expensive, you can't decide by looking at the NFO NAV. Now, investors in NFO don't know anything about which stocks and how many stocks and what percentage of allocation would be done by the fund manager after they have invested. So in IPO, you know about the company, you have seen hopefully that this company does this, and this is how the balance sheet looks like, and this is how they are going to use uh, the money they are raising via IPO. And this is the P&L statement, this is the cash flow statement, etc., etc. But in NFO, you don't know anything. You might have just an idea that, no, this is how my money is going to be used. These are some companies which might get be invested in by that NFO fund manager, but absolutely no idea you would have if you are investing in NFO. NAV can change because changes in the stock prices or quantities or both, or in case some new stock gets bought and it will have a price, so that also will affect the NAV. Now, NAV again doesn't change if new money comes in. Yes, if new money comes in, it doesn't change NAV. But old people, if they start redeeming their units to the point where fund manager has to sell his units, that means that might bring some pressure on the security prices, which kind of act as self-fulfilling prophecy that some investors is pulling money from portfolio or some scheme which is leading, which compels fund manager to sell some securities in the market, which again leads to security prices going down. So that's how the NAV works. In case you want to discuss anything more, I would be very happy to discuss with you on my WhatsApp 80889238849. Like, you can call me on 9663520068, and you can anytime email me on ashish@kubercab.online. Thank you and happy investing.